Okay, today let's have pre-recorded sessions. We'll look at the theory. Start with theory. Let's start with theory. Okay. Because we first really need to understand what forex is. I don't like starting in the middle when I'm teaching someone forex because I do not know what you have learned. So we have to do a recap of theory before we go to practice. Okay, my name is Philemon Najebo from Raki Forex. Let's first define what forex is. We can define forex as a foreign exchange. Forex is a foreign exchange. Foreign exchange is a process of changing one currency into another currency for a variety of reasons, usually commerce, trading, and tourism. Okay, let's say you want to buy something in Angola. If you want to buy something in Angola, you have to convert your Namibian dollar to kwaja or kwanza. Okay, if you want to buy something in South Africa, you convert Namibian dollar to ZAR. Unfortunately, those ones have the same value, so it's like the same currency, meaning there is no difference. But if you want to convert Namibian dollar into US dollar, you can do so through a bank or through exchange, the currency exchange shop. Okay. Or through tourism. Let's say you want to go and visit America. You don't go there with your Namibian dollars. You need to convert your Namibian dollar to American dollar, US dollar. That's when you exchange currency. Or when you are trading. Okay, if you are trading, you exchange currency whereby you buy one currency while selling the other. Okay, what is the forex market? Okay, the foreign exchange market is where currencies are traded. Currencies are important to most people around the world, whether they realize it or not, because currencies need to be exchanged in order to conduct foreign trade and businesses. If you are living in the US and want to buy cheese from France, either you or the company that you buy this cheese from has to pay the French for the cheese in euros. Okay, that's when you exchange currency. Okay, our focus now is not mainly into currency exchange only, but into forex, as we'll be focusing on trading. Okay, we'll be focusing on currency exchange when trading. Okay, trading is just exchanging currency through a platform that allow you to change the currency without going to a shop or to a bank or to another country. So you can just do it at your own comfort, at the comfort of your home. All you need is just a phone or a PC and the internet, and you'll be able to do this exchange. You'll be able to take part in the foreign exchange market. Okay, how do you do that? You do it by speculating. Okay, it's called speculating. You are speculating that, okay, I want to buy euros. Why do you want to buy euros? Because you think the euro will gain value as when you buy it, or you bought euros, then you say let me sell the euro because I think it will lose value. Okay, because you have more euros. Okay, you need to capitalize on that move. If euro lose value, you need to capitalize on that. If euro gain value, you need to capitalize on that. Okay, um, factor like interest rates, trade flow, tourism, economic strength, and geopolitical risk affect supply and demand for currencies, okay, which creates daily volatility in the forex market. An opportunity exists to profit from changes that may increase or reduce one currency value compared to another. A forecast that one currency will weaken is essentially the same as assuming that the other currency in the pair will strengthen because currencies are traded as in pairs. Okay, this means that one currency needs to in a currency pair, one currency needs to lose value and the other one needs to gain value. Okay, if one currency lost value with maybe uh, 30 cent, this means that uh, this pair is likely to go down. But if one gains value, maybe with 30 cent, this means the pair will go up. And this is what you will be speculating, depending on the factors that we outlined, like interest rate, trade flow, tourism, economic strength, geopolitical risk. These are the things that you need to be on the lookout. That's mostly if you are a fundamental trader. You need to look out for news that will tell you that okay, this country has strengthened its economy. Its economic was strengthened, like especially this time of COVID-19. We know, like, let's say USD ZAR. We know that South Africa is severely affected by COVID-19. So we expect that, okay, since United States, those countries, they have a vaccine already, we expect their economic to boom, okay, to go up. And we expect that, okay, like South Africa, for example, we expect that the rent might lose value. Okay. However, trading forex is risky. Okay, there is a risk involved in forex trading. Okay, trading currency can be risky and complex. The interbank market has varying degree of regulation, and forex instruments are not standardized. In some part of the world, forex trading is almost completely unregulated. And these are the things that you need to be on the lookout. Okay, there are platforms that you use, and you need to know that okay, this platform is regulated. Let's say we have brokers. Okay, the brokers are the one that gives you a platform to take part in the forex market. Okay, so these brokers, they are regulated, but in some countries they are not regulated. Okay, because the country knows that the market can easily be manipulated. Okay, we have seen the closure of some brokers. We know what happened to JP Market. JP Market, it was shut down because it's robbing people. Okay, it's robbing people. So that's why you need to trade with a regulated broker, because this broker, if it's robbing you, you can report that okay, this broker is scamming me. They are messing with their charts. So as a result, we are losing our money that we invested with them. Okay, so be aware that forex market is risky. Okay, let's move on to currency pairs. Okay, when you are trading, you trade two pair. Okay, in this two pair there is a base currency and a quote currency. is a quote currency. Let's rotate. Okay. The first currency in the pair is called the base currency, while the second currency is called the quote or counter currency. The price of a base currency is always calculated in units of the quote currency. For example, the exchange rate for Euro USD pair is 1 to 1000. Okay, so let's say here the base currency is Euro and the quote currency is USD, and this means that when you open a sell order, this means you are selling Euro and buying USD. But if you buy, you are buying Euro while selling USD. This means that when you buy, you expect Euro to gain value while US dollar to lose value. And this is a basic thing that most of the traders don't understand. Okay, this is what most of the traders don't understand, and this is why they lose money. Okay, so this will give you an understanding that in the most traded pairs, there's Euro USD, there's Euro JPY, there's Euro GBP. So you find yourself contradicting yourself. Okay, you find yourself contradicting. You find out that you will be contradicting yourself when you are opening an order. Okay. Like this, this is sorry. Okay, sorry for that. It's like this. USD, GBP, JPY, Euro, USD, JPY, GBP, USD. Okay, just trying to emphasize on one thing. Let me look at it. Okay, let's say you have a Euro USD pair and you have USD JPY and you have GBP USD. Okay, by here we have base currency. Let's say we are opening three trades. Whereby we have Euro as a base currency, USD as a base currency, and GBP as a USD currency. So GBP as a base currency. We also have the quote currency where we have USD, GBP, JPY, and USD. It's a quote currency. Okay, let's say we sell these three pair. We sell. Okay. If we sell these three pairs, okay, we sold Euro USD. We are saying a Euro will lose value. Okay, Euro will lose value while USD will gain value. Remember, these are the trades that we opened at the same time. Okay, we sold USD saying that USD will lose value while JPY will gain value. Okay, we again say GBP will lose value and USD will gain value. Okay, these are three orders that we sold from three different pairs. Okay, let's say when we sold Euro lost value. Okay, euro lost value, which means we'll make money in the first trade. Okay, but what will happen to USD? Euro lost value, USD gains value. These all that we just opened at the same time. Sorry that I'm not displaying this on the screen. Hello, can I just add this? Okay, fortunately I cannot add the screen because I'm not on a Zoom presentation. It's just on my screen. Okay, however, let me just move to my camera quickly. Come on, be fast enough. Okay, you can see this. Okay, we said we sold euro USD. Sorry, this name, somebody's name here. Sorry for that. Okay, sorry for the interruption. Come on, I'm on a timed here. Yeah. Oh, okay. Let's say this is a winning trade, the first one. This is the winning trade, the first one. What about the second one? We sold. Okay, we know here USD is gaining value. This means this is a losing trade, because if in this pair USD is gaining value, this means this one will be wrong, because if USD is gaining value, GBPY will be losing value. Okay, Japanese yen will lose value. What about this one? This is GBP USD. Okay, we know that USD is gaining value while GBP is losing value. Okay, so we sold a GBP hoping that it will lose value, and it's losing value. Okay, this one will be in profits. But in a nutshell, we were not supposed to sell this pair. This pair here, we were not supposed to sell it. We actually were supposed to buy it. These are the things that you need to be on the lookout. You should not be contradicting yourself. Okay, you should not be contradicting yourself, because now if the market goes the other way around, okay, let's say we sold, but then USD did not lose value, it actually gained value. Okay, it actually gained value here. As we said, we sold here. Okay, let's say euro did not lose value, but it gained value, and this one is already a wrong trade. Okay, and this one also, GBP did not lose value, but it gained value. This means you are losing money. Okay, so be always on the lookout when you are trading. Don't contradict yourself, and don't contradict the market. There's a theory that says we buy low and we sell high. Okay, so whenever you're trading, you need to buy low and sell high. Okay, let's move on to a pip. What is a pip? These are the terms that you'll be hearing, especially if you'll be taking signal. You'll be hearing that. Okay, let's book this 100 people, or 10 people, or 30 people. Okay, when you're talking about a pip, is a base unit in a price. Okay, the base unit in a price of a currency pair, or 0.00101. Okay, this is how you profit in the forex market, or the other code price in the non-JPY currency pair. So when when the bid price for Euro USD pair goes from 1.16667 to 16677, okay, we'll see the difference, the one difference here, okay. The fourth digit after the comma, that's where we capitalize on, okay. We capitalize on the fourth digit after the comma. We'll see there are certain numbers after the comma, so these are the this is the amount that we capitalize on, okay. We can see the picture there, it's very clear, okay. The fourth digit, if the fourth digit increase, this means we are making profit, okay. If it increase and we bought, we are making profit. If it decrease and we sold, we are making profit. But if it goes the other way around, it also means we are losing money, okay. There's also a spread. A spread is something that you need to consider, especially when you are choosing which currency pair you will be trading, okay. You don't just pick any currency pair that you want to trade, or you don't just choose any indices that you want to trade, or just so you need to consider a spread involved in this, because until this distance is covered, that's when you start profiting, okay. The spread is a difference between the purchase price and the sale price of a currency pair. For the most popular currency pair, the spread is often low, okay, sometimes even less than a pip. For pairs that don't trade as often, the spread tends to be much higher before a forex trader becomes profitable. The value of a currency pair must exceed the spread, okay. The value of a currency pair must exceed the spread. That's when you start profiting, okay. Okay, where you see a buy in the picture, that's, let's say that's where you buy. For you to start profiting, okay, the spread must be covered. Let's say you sold where there's a sell, okay. You only be your order will only become profitable when the market move until it covers up to where there's a buy. Going up, that's where you profit, okay. So when you're choosing a currency pair, choose the most traded currency pair, the strong ones, okay, because they are most traded, especially the currency pairs that involves USD, okay. The currency pairs that involves USD or euro, okay, they have a much smaller spread, but the spread will depend on the broker, okay. So you should also compare different brokers before you decide which one to trade with. There is also a margin, okay. A margin is the money that is retained in the trading account when opening a trade. However, because the average retail forex trader lacks the necessary margin to trade at a volume high enough to make a good profit, many forex brokers offer their client access to leverage, okay. There's a certain amount that you need to start trading in the forex market, and that's called a spread. We say the broker will give you a leverage. This concept is a must for beginners forex trader, okay. So you need to understand what leverage is. Stand up and do research on what leverage is, okay. The leverage is capital provided by a forex broker to increase the volume of trade its customer can make, okay. Because in an actual fact, you cannot start trading with 10 USD. That's a fact that you will not be able to start trading with 10 USD. But for the brokers to make it possible for you, they lend you money to trade, okay. They lend you money, and this money is called leverage, and it's really up to you to ask that, okay, if I'm depositing 10 USD, you should give me 100 USD or 1000 USD for me to trade, okay. one thing that you need to know is the higher the average, the higher the possibility of your losses, and also the higher the possibility of your wins. Okay. The face value of a contract or a lot equal to 100,000 units of the base currency. In a case of Euro USD, it would be 100,000 euros, and obviously you will not have 100 USD. Where will you find 100,000 USD? If you had that amount of money, you wouldn't even want to trade at a after all. Okay, if you use 1 to 10 average rate and have 1,000 euro, okay, let's say you have 1,000 euros and you use 1 to 10, okay, euro in your trading account, you can trade a currency pair with 10,000 position size. Okay, if your trade is successful, leverage will maximize your profit by a factor of 10. However, keep in mind that leverage also multiply your losses to the same degree. Okay, chart type. When viewing charts, okay, when you'll be trading this currency space. You will not be seeing numbers. You'll be seeing numbers, but in the form of charts. Okay, you'll be seeing charts on the platform that you'll be using to trade. It's not like at the bank where you just need to know the value of a currency that day. So with this, because this is what's happening in the exact moment. Okay, the platform allows you to trade or to capitalize on what's happening at that same moment. Okay, when viewing the exchange rate in live forex chart, there are 3 different options available to trade using the MetaTrader platform. Okay, you will be using MetaTrader platform to trade the line chart, bar chart, and candlestick. Between these different chart types, by selecting view toolbar standard option in the toolbar of to be to the screen, you will now be able to see the box below. Okay, you can see the box. The first one is OHLC bar chart. Okay. The second one is a candlestick chart. The last one is a line chart. Okay. Which system will you be using? There are systems that you will be using. Okay, now that you know how to start trading in forex, the next step is to choose the best forex trading system. For beginner, unfortunately, bank corporation investors and speculators have been trading in the market for decades, meaning that there are already a wide range of type of forex trading strategy to choose from, and this include, okay, you need to decide which system you will be trading. There is currency scalping, there is intraday trades, there is swing trading. Okay, the currency scalping, for you to be a scalper, scalping is a type of trading that consists of buying and selling currency pair in a very short period of time, generally between a few seconds and few hours. This is a very practical strategy that involves making a large number of small profits in the hope those profits accumulate. Okay, when you're a scalper, you'll be monitoring the market, that okay, now I suspect that the market will go up, so you buy and you stay in the market for maybe 10 minutes, 30 minutes, 50 minutes, 1 hour, 2 hour. Okay, in a very short time you will be scalping. Okay, if you only go in the market in and out, that you think the market will go up now, you buy. If you think the market will go down now, you sell. Especially fundamental trader, you just go in quick, in and out, in and out. We have very volatile if there is high volatility. Let's say you are trading Nasdaq, we know that Nasdaq is very, very volatile, so you know that maybe at probably 15:30 Nasdaq always make a huge move. Okay, so you need to capitalize on that huge move. You just open a trade. Let's say you open a sell order. You think the market will go down. Okay, you just go in. You wait for 5 minutes. You close your trades in profit because you knew that the market will go down. Okay, if you keep holding it, the market will go down and it will come back and go up. Then you will lose money. Okay, that's what we call scalping. There's intraday trades. Forex intraday trading is a more conservative approach that can suit beginners. It's focused on 4-hour or 1-hour price trends. Trades can be opened between 1 and 4 hours. In general, they focus on the main session for each forex market. Okay. If you're in intraday, this means you open trade and wait for maybe 4 hour, 1 hour. You need to capitalize on the trend. Okay. So the main is between 1 hour and 4 hour. Okay. We also have a swing trading. Swing trading is a medium-term trading approach that focuses on large price movement, that's scalping or intraday trading. This means that traders can keep a trade open for days or a few weeks. This type of trading is a good option for those who trade as complement to their daily work. Okay, let's say you have a daily job. You will not have time to monitor your phone for in an hour or two. Maybe you don't even touch your phone for 5 days, or not for 5 days. I mean, for maybe you start work at 8. Okay, if you start work at 8 and only knock off at 5, this means you only open a trade thinking that, okay, today I think that the overall move for USD, for Euro USD, it will be an uptrend. Okay, it will be in an uptrend. So you only open an order that, okay, I'll open an order at 8. Maybe by the end of the day, the market will still be going up. Okay, maybe somewhere during the day it will reach a certain point. Okay, so you open a trade and you maybe only come monitor your trades once. Let's say if you are a teacher, you come and monitor your trade during break time. Okay, you do analysis in the night, maybe 4 to 5 in the morning. You do your analysis, you open your orders, and you go to work. You come and look at how your orders are performing in the afternoon, and you only come to close your trades after work, or you would expect your take profit or your stop loss to be hit after work. Okay, this is swing trading. Okay, how do you know that the market is going up? There are signs that tells you that the market is going up or down, and we use a candlestick. The most used speculation, you speculate according to the candlesticks the market is giving you. Okay, there is always an upper shadow. Let's start here. There's an upper shadow, real body, and lower shadow. That's a candlestick. Okay, those are the parts of a candlestick. Okay, we have an upper shadow, a real body, and lower shadow. Okay, we have the highest price where the market has been. Okay, in a candlestick, that's where the upper wick ends. That's where the highest price where the market has been. Okay, we have an opening or closing. This depends if the market is going down or up. If the market is going down, the opening is on top. Okay, the market will go down until the lowest price. From the lowest price, it will come up again, then it will go to the closing. Okay, at the center section is a body, so you need to look at the body of a candlestick, because it will show you the volume or the pressure. Okay, the bigger the candlestick, the higher the volatility. The smaller the candlestick, or the shorter the candlestick, the smaller the volatility. Okay, let's move. We have trends. Okay, the market moves in zigzag form. Okay, the market doesn't move in a straight form, it moves in a zigzag form. Let's say it will uh, it will come down, go up, come down, go up. Okay, it move in sideways. Okay, maybe it only goes up a bit, come down a bit, go up a bit, come down a bit, in a equal distance, in an equidistant. Okay, but the market doesn't always stay constant, it's always moving. Okay, this allows you to always meaning each and every day is a trading day. But this doesn't mean that you should trade each and every day, because your trading will be depending on what type of trader you are. Okay, you are a scalper, intraday, so you need to capitalize on the moves that goes together with which type of trader you are. Okay, don't just say you are a scalper, but you open a trade at 8 in the morning, just to expect your stop loss to be hit at 5 o'clock in the evening. This means you have been in the market for too long. So this means you are likely to lose more money or to make more money. It depends how the market goes. But you need to know which side you are. Don't just be going ahead when you don't know the direction where you are going, because then you will make mistakes that you would have avoided. Okay, we have a sideways trend. A sideways trend indicates that the currency movement is range bound between levels of support and resistance. It's usually okay when the market does not have a sense of direction and end up consolidating most of the time in this range only. Okay, mostly when the market is raging, you are likely to lose money. Okay, you are likely to lose money if you open a trade when the market is raging, unless if you are a scalper and you know what you are doing, so you need to capitalize. Okay, sideways trends are good for scalper, but for the experienced scalper, because now the market will be going up, down, up, down, up, down, and this range, in the range that they are in a range where the market is moving, you'll be able to capitalize on that. Okay, let's say you open sell limit at the resistance. Okay, you can open sell limit at the resistance, and you put your stop loss above 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 the level where the market is raging. Okay, then you put your stop loss at the support, then you make money. But should it break out of that resistance, then you lose money. Okay, to identify if the sideways trades often draw horizontal line connected by the highs and low of the price. We then from the resistance support level. Clearly, market participants are not sure of which way the market will move, and there will be a little or no rate of price changes. Okay, sideways is caused by when, like, the buyers and sellers, there's an indecision. Okay, you'll be looking for candlestick that shows indecision between buyers and sellers. Okay, there's an example here of a sideways trend. We can see the resistance level and the support level. Okay, let's say at first you okay. Let's say somewhere here, just at the first way where it first touch the resistance. You sold, okay? You sold and you take profit where it touched support. Okay, let's say this is where you start your analysis in the first place. Okay, this is where you start your analysis. You saw that the market hit the resistance level and it was resisted, and it touched the support and it was supported. Okay, you wait, you see it almost hit the resistance level, but it didn't. Okay, so now that one you ignore it. You wait until it touches the support. When it touches the support, you buy. Okay, when it touches the support, you buy. You buy and wait for it to hit the resistance level. Okay, and it only hit the resistance level here was. Okay, now you took your profit and entered a sell again. Okay, you entered the sell. Let's say you saw that huge weak rejection, then you entered the sell. Okay, well, now that you entered the sell, the market kept going down, 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 and it hit your take profit at the support level. Okay, we see that the wick has entered a bit the support level. Okay, this is because it's called a level, not a line. Okay, this is one thing that you need to know, that it is a level and not a line. It doesn't matter that you have drawn a line. Okay, at least try to draw a level. And when you are setting your take profit and your stop loss, know that this is a level. So your stop loss should not be tight. At least it should be above the lead line. If you are selling, if you are buying, your stop loss should be below the green line. That's the only way you make money. If it's not below, the market will come down and hit your stop loss. Okay, let's say your buy order was activated, and the market kept going down. Okay, it will go down and hit your stop loss. You'll be thinking that no, it hit my stop loss, let me sell. Okay, maybe you'll be thinking that okay, this is probably a breakout, but it's not a breakout because you did not wait for a confirmation. You just probably decided that okay, let me sell, but you sold and you lose money. Okay, so be careful when the market is raging, or even when it's trending. You need to know that it's a support level and a resistance level, not a line. Okay, we also have an uptrend. Okay, an uptrend signifies that the market is heading in the upward direction, creating a bullish market. It indicates the price rally, often with intermediate period of consolidation or movement, small downward move against the major or prevailing trend. An upward trend continue until there is some breakdown in the chart, going down before some major support area. If the market trend is upward, we need to be cautious on taking short position. Okay, we have short and long. Okay, and you need to understand these things because you'll be hearing about them a lot. Okay, a short is when you are selling. Okay, a long is when you are buying. If somebody say we are going long, it means you are buying. If you say we are going short, we are selling. Okay, so here you will be going long. We saw the high low. Okay, we saw the first high low, we saw a high, which confirms that okay, it's now an uptrend. Okay, we wait. Now when we saw another high low, it confirms, then we enter. Okay, we enter so that we'll have a stop loss down there. Okay, the market is going up, so we only buy. We wait for it to come and touch the line again. Okay, when it touches the line again, maybe we take our profit, or we can hold, or we can move our stop loss below the high low. Okay, this allows you to save your money. Let's say you bought at the second touch, that's why you bought. At the third touch, you can move your stop loss above that high low. Okay, this means you'll be in profit and you'll be safe. Okay, then you can put your stop loss somewhere on top there where you think the market will go. This means you are safe. Should the market not reach your take profit, you will not lose money because you are safe. And this is for me this is a critical stage. Okay, this is a critical stage where you always wait for a market to, so as long as your account is good, the market will support your retracement. When the market try to break out of the support line or support level, and it decide then to go up, this means you make money by that way. Okay, we have a downtrend is just the other way around of an uptrend. In this case, the downtrend is a forex market, is a characteristic by a price decline in a currency pair, a USD in INR is what now, with slight upward swing for a period of consolidating against the prevailing trend. Unlike upward trend, a downtrend results in a negative rate of price changes over time. In a chart, the price movement indicating a downtrend form a sequence of row peak and row lows. Okay, as the currency always trends in pair, the downtrend is forex market is much affected as the financial market. In case of a downtrend, a currency pair USD NL, at the fall in price of USD, okay, USD need to lose value for a market to go down. Okay, give away a rise in price of INL. Okay, it means something is always going up even in times of a financial economic downtrend. Okay, here's an example of a downtrend. We are seeing a lower high. Okay, this low will be higher than the previous low. Okay, say lower high, lower high while it's forming a lower low. Okay, when the market is going down in a downtrend, it will be forming a lower low and a lower high at the resistance level. Okay. Okay, that was much on our basic forex basic lessons. We are going to move on to analysis on the next video. Thank you for watching that very long video. Hope you have learned a lot from it.